US retail sales numbers skyrocket, further empowering Fed hawkishness. Hi, everyone, and welcome to Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, Branko is back with us to discuss lots of interesting data that has been coming out of the US and implications more broadly across markets and the economy. How's it going, Branko?
Good, Tipper. Thanks for having me back on.
So the news piece today was really quite interesting. Lots of information that's been coming out that really wasn't quite what people were expecting. So can you start off by talking a little bit about those CPI figures and what happened there?
Yeah, so earlier in the week, we had the CPI figures come out. They were higher than expected. So expected inflation rate was 6.2, came in at 6.4%. But what was most interesting was the market's reaction. And we actually saw the market rally off that, including Bitcoin today, which went over 10, 11%. So usually when inflation's higher than expected, it means more rate hikes are anticipated and we see markets react negatively. But in this situation, for whatever reason, they've absolutely spiked up. So it's a very interesting market environment at the moment.
I found that really interesting as well, particularly the crypto Bitcoin one you were talking about. We just saw the market really take off today, and really we shouldn't have seen that because people were quite expecting that if the number was higher than what was expected, that the markets were really setting up to tank lower, and that didn't happen. So I did think that was quite interesting. I mean, I've been looking at and reading a little bit of stuff around liquidity starting to pick up again, to say that markets generally are seeing more liquidity flowing in from places like China and different things that are going on around the world. But really, on the short term, that was quite unexpected.
Yeah, I think my only short-term explanation would be possible short squeeze. So people were kind of anticipating that it was higher than expected. And when they didn't get that follow-through negative reaction, those people closed their positions in kind of a forced, stop loss type situation. So everyone closed their position at once and market spikes. But I think, medium to long term, your explanation makes a lot more sense too, with funds coming in now and liquidity re-entering the market.
So yeah, longer term it could be something different, but for the time being, it's really quite uncertain. Something else that really caught the market off guard, I think, were those retail sales figures that you spoke about. And I know there were charts and things in the news today that really opened my eyes, because it's quite aggressive, the uptick in retail sales, and that's something we wouldn't be expecting to see right now, is it?
Yeah, so we've had the highest increase in retail sales, month to month in over 2 years. And these things are seasonalized, so they do account for the Christmas period and so on. But typically these figures are seen as this a sign of consumer spending and economic health. And it's very interesting to see that retail sales is much, much higher than expected in the current interest rate environment, where you would think that people would be a bit more conservative with their spending in anticipation of further interest rate hikes. So I think it's something to follow, and I think it has a lot more broader impacts on the economy, and we'll dig into soon kind of why it's gone up and what the implications are in that as well.
Sure, because I really don't think the Fed would be very happy about that, would they? Because really, that's kind of the opposite of what they're trying to achieve right now, isn't it?
Yeah, I mean, you'd absolutely expect the Fed to be even more empowered, more emboldened to continue these aggressive rate hikes with this new data, combined with the CPI data, and then you have the unemployment data as well, where the employment's looking strong. So the Fed's only emboldened now to just keep pushing and keep raising the interest rates.
I'd like to dive into that a little bit further too. So you've talked about the retail spending being high, but the argument and the discussion we've been having on here quite a bit is around real wages, and the fact that even though people are probably starting to see their wages go up a little bit, those pay rises are probably coming through for a lot of employees, they really haven't outstripped inflation. So you've got people who are actually experiencing significant hardship because their real rate of pay has gone down. So that doesn't really add up to me. How are we having high levels of retail spending, but at the same time, real wages falling?
Yeah, so there's an interesting graphic I think we'll show up on screen of real wages and how, since 2021 they've actually fallen quite significantly, and it doesn't make sense on the surface level. But the key here is that people are absolutely abusing credit cards at the moment. We're at record levels of consumer debt. and people are funding their consumer spending with an increased, increased credit card debt effectively. So even though their rates are going down, I don't want to throw any kind of allegations out there, but it seems as though the ability to get capital as a consumer hasn't been as easy as it is now, right? It's very easy for people to get credit cards at the moment, and banks just handing it out, and we'll get into that particularly in Australia shortly. But yeah, people are borrowing more than ever, and I think it's creating a very unstable economy that we're living in. We have people borrowing at record rates. We have interest rates continually going up, inflation not really going down. So it's a very kind of difficult time.
It can be very turbulent, absolutely. And I was reading some stuff about that as well, where you've got, and you're seeing these stories actually in the popular media all the time at the moment about people really not being able to make ends meet and turning to credit. The worst, of course, being credit cards, and those rates are just huge, aren't they? I think I saw something in the news there about the actual interest rates are extraordinary.
It's insane.
It doesn't help the situation when we've got, I don't know why people make those decisions sometimes. I think it's out of desperation, but ultimately there must be a lot of hope in there that things are going to turn around. And there doesn't seem to be any indication from these numbers that anything is going to turn around anytime soon, is there?
Yeah, it's difficult to see a good turning point anytime soon. You've got these, credit card interest rates, we'll put it up on screen of like 20%, unbelievably high. And people have to, if they're using credit cards in the first place, they don't exactly have the capital already. So then they have to find a way to pay it back. So it's going to be very difficult for a lot of people.
So I suppose that turns the conversation to something that's a little bit, or can be a little bit controversial, and that's the banks. And we've seen, and you've commented on really quite significant profit taking that's been going on there. So is there a little bit of advantage being taken of people in this situation? What's your take on the banks and how that plays into this?
Yes, this is something I want to touch on in light of these retail figures and this kind of spare of credit card use to get to those higher retail figures. Is the banks are absolutely taking enormous profits at the moment. It is unbelievable what is going on. We have Commonwealth Bank recorded record profits this year of $5.15 billion for the half year. Sorry, that's not over 12 months, it's over 6 months. $5.15 billion profit. That's not revenue, that's profit. All right. In an environment where rates are rising more than ever. And when they pass these on to consumers, they don't exactly just pass on their costs. They pass on their costs plus their little spread. And then each time the rate hike, if it goes up by 0.25, they pass it on by 0.3. And then if it happens next month, another 0.3. And then before you know it, there's a very significant gap between the rate they're offering on your home loan and the rate that they're being charged, or the cash rate. So, banks, I think, are going to be performing very well. And if, you hold a lot of shares in CommBank, I know they didn't respond the best in the share market, but you would assume continued profitability. But I think it's just, I think it's something that you can argue about the ethics of it, but it's just something to really follow is how these banks are really taking advantage of this situation. And it is kind of sad to see.
And from a broader perspective, I've had a conversation this morning with someone actually about this, the idea that ultimately those profits that you talk of and that money that's flowing back in, that could potentially be inflationary down the track. And it might not be inflationary in the sense of the cost of groceries at the store, but it probably feeds back into things like asset prices and property prices. Because you have to think about the people who actually receive that profit. So the owners of the shares will often be investors, obviously. Or super funds and things as well, of course. But those profits flowing back in probably actually spur another round of higher prices in assets, which aren't necessarily helpful for what the Fed in the US or the RBA here is trying to achieve either, are they?
Yeah, that's correct. That's a good point as well.
Because it's something to think about, that profit goes somewhere.
Yeah, that's true.
All right. Well, Branko, thanks for your efforts on discussion on the news today. There's lots in there that I think we do need to be paying attention to, and I really like that point that you're making about watching a little bit closer at the ground level of people who are really needing to use things like credit cards, because there's information there that we probably need to be watching.
And I would just say on that as well, in terms of how, the banks, obviously, if people require capital, they're going to have a lower kind of elasticity for the interest rate as well. So that, you know what I mean? So if they need the money now, they're going to take whatever. And obviously it's a good opportunity for banks to kind of interest rate gouge, which is what we're seeing in the credit card market at the moment. So that probably also contributes to the increased profit, is that people need money more than ever to fund stuff, and they don't really care what interest rate they get.
Yeah, that's right. And that's the only way you can charge those rates, really, isn't it? If people aren't desperate, they're not going to pay them. That's for sure. All right. Well, thank you so much for that. Thanks also to everyone for watching. Remember, if you've got any questions about that, reach out. Branko or I will be happy to respond on social platforms, or we'll talk about that next week when we're on. So that's us for this week. I'll be back on Monday with Alex. But until then, have a great weekend and good luck out there in the markets, everyone.